Hey, what's up guys? I'm here at the Rose Garden at the University of Southern California, and I've got a video today talking about the disproportional upside and downside for a sponsor associated with the pursuit and acquisition of property. So it's pretty well acknowledged, and a lot of people pointed out that a sponsor receives disproportional upside on a deal when they acquire property, right? They get a nice acquisition fee up front, and then if the deal does very well, they get really good compensation on the promote. If the deal doesn't do so well, they don't really experience a monetary downside unless they've co-invested. They do, however, experience reputational harm, which is very important. So, the more reputation that they have on the line and the more personal co-invest, the better. You also have the downsides associated for a sponsor when they're in pursuit of deals, right? And this is all about the deal after deal after deal that they need to source and underwrite and then diligence as they're looking for that next deal to actually close on, right? And so this diligence doesn't only just take their time, but it also costs money. We're talking about flights, hotels, legal, third-party report, the loss of earnest money deposits that go hard. And so this is a very, time-consuming and potentially costly experience depending on how you go about your business. And in my opinion, the reality of it is, if you're a hard-charging sponsor and you're out there looking for the best deals, you're going to get yourself into situations where you end up chasing a value trap, or basically a deal where you thought there was something there. You did your home, you got excited, you went there, you did your due diligence, and you actually uncovered that the value that you thought was there really wasn't. So you have to terminate the contract or just terminate wherever you happen to be in the process, whether it's at pre-LOI, LOI, PSA, and there are time and monetary consequences of doing so, but that's the cost of pounding the pavement and finding those best deals. So when a sponsor is doing all that and they finally get to a deal where they're actually ready to close, when you're, as an investor, paying for that acquisition fee on that particular deal, you're not just paying them the fee for that deal, you're paying for all the hard work that led up to that deal. And that's the relationship between the asymmetrical downside for the sponsor and being judicious and being willing to have the maturity to walk away from a deal and incur those costs personally, right? They don't get investors at that time to pay for those costs. That's all on them, right? So when they do get to that deal that works out, that's where they're compensated for all those times that it didn't work out. And just to give you an example, we had a deal not too long ago that we were really excited about. It was very complicated. It wasn't your typical fairway down the middle deal. There were nuances to it, and the business plan was complex, the debt was complex, but through all the complexity and uncertainty, there was a big return premium. So it had us excited, it had our investors excited, and we went through many hurdles to pursue it, to analyze it. We were in the market, and after doing all of that due diligence and investing so much time and money into the deal, actually being hard on a portion of our deposit, it took a lot of maturity, and by no means was it easy, but we ended up walking away from the deal and losing a piece of our earnest money, and obviously all of our due diligence costs and our legal fees, just to protect ourselves and, more importantly, protect our investors from going into a deal that we were no longer comfortable with. That's the topic of today's video. Wanted to share the difficulties and the downside that a sponsor personally takes in pursuing deals, and then on the flip side, the disproportional upside that a sponsor gets when actually closing a deal. Thanks for watching.